Hi, Eric Coiner here, President and Founder of Triathlon Partners. Thank you very much for joining us on this episode of Triathlon TV, where I'm going to discuss some of the tax plans that have come out from the candidates running for president. Now, I've seen some articles, I've read them. Whether or not people are going to flip-flop and change them, I don't know. But recently there's something that came out saying that there was going to be not only a capital gains tax on gains that weren't realized, the capital gains tax on realized assets was going to move from either 15 to 20%, depending upon your income level, up to 44%. Now, just want to explain the dynamics on what that's going to sort of impact. Now, that might be super fantastic for the U.S. budget. It might be really great to fund other programs. I think you have to look and sort of think what something like this it will do and affect everybody's wealth out there, which I think is very important. But it's important if you want to preserve your money as well as have an opportunity to make money, if in fact these news rumors that I'm reading are true, right? So what happens is, first of all, let's just talk about the simple long-term capital gains. You own something for over a year, you sell it. Stock is just very easy. You own a stock at 20. You bought a stock at 20. You own it for many, many years. It's up at 100. You want to sell it. There's $80 worth of profit. The capital gains rate, let's say for you in particular, because of your income, is at 23.8%. So for ease of, it's 20% for the capital gains, and then there's a Medicare surcharge of 3.8%. So instead of 23.8, I'm just going to say 25 because it's just easy for math right now. So we'll know we're a little bit higher on the taxes that we're going to pay under the current laws. So between 20 and 100, you've made $80. 25% of $80 is you will owe $20 in tax, right? So you sold it for 100, you got to pay 20 in tax, you're left with $80. That's great. Okay, fantastic, no problem. It's reality. It's not saying, I'm not commenting on whether or not the rate of taxes is fair, unfair, too low, too high. I don't care. It's reality, right? So let's now go to a dynamic that these long-term capital gains rates, even though I saw in the paper, it's at 44.8, I'm going to go 50. I rounded up on the other one. I'm going to round up on this just for the sake of mathematics. And I don't have a blackboard behind me. So if you bought that stock at 20 and now it's at 100, and you're like, okay, I'm going to have to pay 50% capital gains tax. If you sold it at 100, you'd make $80, just like the other, situation. 50% of 80 is 40. You pay $40 in taxes, and you're going to be left with $60, right? So in the first scenario with the lower tax, you're left with $60, and in the second, you're left with $80, and in the second scenario, you're left with $60. It's a $20 difference. So that's fine. Again, not commenting on the level, if it's right or wrong. I'm more concerned about the math and predicting what people are going to do once these laws, if they are passed. I don't even know if they're up for being passed. But this is just a good discussion about how this affects people's behavior. So let's say that we have these two situations, and these taxes are looking to go up. And well, what am I going to do being someone who has this position, knowing the stock's at 100? If I sell it out now, I can get $80, or I like the stock. It should go up. Well, tell you what, if I sold it right then, I'd get $60, which is far less than 80 if I, because I waited after the law was passed. But, where does the stock have to go for me to get the same $80 as if I sold it today before the law became enacted? That's the comparison. So if that stock after the capital gains tax long-term got raised to 50%, I would need the stock to go to 140. That's from 100 because I bought it at 20. If I sold it at 140, I made $120 profit. 50% of $120 is $60. I would pay $60 of tax after I received $140 in the proceeds from selling. That's $80. Now, I want to ask people this question. If we knew right now the market's at 100, and if we knew that this change in the tax rate was going to happen, how many people would decide to sell it now at 100 so they can take home $80? And how many people would decide, I'm not going to sell it, and I'm going to wait because I like this stock, and I think capital gains taxes going higher are super fantastic? Well, for them to make the same amount of money, the stock has to go from 100 to 140. That's a 40% increase in the stock. All right, now, if you think anyone with half a brain will say the latter and hold on the stock, waiting for it to go up 40% to earn the same amount of money in their pocket, then you're crazy, right? It isn't going to happen. So what's going to happen is a lot of people who have profits in these stocks, on these stocks that have gone up and up and up. You can name them. They're Amazon, they're Apple, they're Berkshire Hathaway, they're Microsoft, Google, Facebook, Tesla, NVIDIA. It just goes on and on. What do you think they're going to do with their stock? They're going to sell it immediately. Oh, okay. Guess what happens when a lot of people at once sell their stock? And who in their right mind, who's an intelligent investor, is going to realize, I want to buy the stock right now, even though all these people are selling the stock because of a dynamic that has been changing in tax legislation? The answer will be 0 people, right? And if there is someone, well, they have a bad advisor and they don't understand what's going on. The majority of people will step aside and let everyone sell the stock as low as possible because they know that big jump in taxes makes a very big difference in the price of where they have to sell it to take home the same amount of money. So I'm not here to complain about the tax rates. I'm here to understand the opportunity that might arise if these tax rates go up. So once again, what I might do as a shrewd investor, well, I would certainly try to take advantage of selling my assets at this long-term capital gains rate that we're saying is at 25, as opposed to waiting and it goes to 50. And if it's less than 50 but higher than 25, well, there's still a level that works. But I also might decide, hey, what's a great thing to buy if I think the market's going to have a lot of sellers? It's called a put. Now, I've already gone very long on this episode, and I want to discuss these puts in detail later on. This is where I made my career and my name in the derivatives market, and I would like to share my knowledge with you, but it's getting a little bit long, and cliffhangers are always good in marketing, but this is real, right? And this is serious, and there's going to be a lot of real money to be made on this opportunity. right? And so from that standpoint, I hope you tune into the next episode. But I want to thank you very much for tuning into this episode. Once again, this is Ira Coiner, president and founder of Triathlon Partners. We believe our role is to engage, educate, and empower our clients to make a confident decision that best meets their objectives. Thank you very much for tuning in. I really think if you've been making it this far into the episode, you really took a lot out of it, and this will form a very strong foundation to your understanding on the dynamics on how the market and individuals will act to policy made out of Washington and understand the potential to make money off of those decisions people will make. So thanks again. Please, we like our stuff here. We love subscribers. We love thumbs up. We love friends and followers. Press those buttons on social media. I know you love to do it. And you have a very blessed day. Take care. Bye.